what you're talking about is an environment where, let's say, credit card delinquencies go up. And as we saw today, they have to cut back on running up the plastic. Well, the next thing they're going to have to do is stop spending so much because they were using the plastic because they didn't have enough cash with which to purchase those things. So spending will slow, which means corporate profits will slow, which will slow employment. And that will steadily grind on to the point that you eventually, the economy will lapse into recession.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here for another bi-weekly macro session with the macro maven herself, Stephanie Pomboy. Steph, how you doing?
I'm great. How are you, Adam?
I am great, and it's nice to see you again all set up there in your abode out west, your summer
Yes.
abode out west. I hope you're having a good time in Vail right now.
Oh, it's just so magical. I absolutely soak up every single second out here in the summer. I wish it were longer, but we take what we can get. Anyway, I hope you are enjoying a beautiful summer out west as well.
I am, although funnily enough, sort of Freaky Friday style, I'm heading out to your hometown in basically 24 hours, which is why we're not doing this live this week. We're having to record it a day in advance, and folks, that's on me. I'm going to Rick Rule's annual symposium out there in Boca Raton. And then we're going to spend a couple days as well near Palm Beach. So we're going to be in your old stomping grounds there, Steph, and we're going to be soaking up all that heat and all that humidity that you're out west avoiding right now.
Well, I feel sorry for you. I'm also a little unnerved by the fact that you're going to be in my hometown when I'm not there
I
because
know.
I don't want to miss the opportunity. But on the other hand, I wonder, like, what possesses anyone to host a conference in the summer, in July, in Boca Raton?
I don't
But
know. I will ask Rick that himself when I see him. So hopefully I have the answer when we do this next time around.
good deal. Well,
Good deal.
I'm guessing the hotel rates are substantially lower.
They're
So,
pretty cheap, I gotta say, but
yeah,
I think I understand why.
yeah.
Anyway, Steph, well, hopefully we can engineer an in-person meeting in
I
Vail
hope.
because that would be fun, period, but also a lot easier from where I normally spend my time out here in California. But anyways, if we can
That's
make it happen, we will this summer.
that's true. We'll go for a ruck together.
That would be great. All
Yeah.
right, well, look, we got a lot to ruck through in today's discussion. And why don't we start with a topic that I know is near and dear to your heart, Steph, which is the state of the consumer. I've seen two stats today that I'd love to get your reaction to. One is, I think, what might be actually a really clean data point. You know, a lot of times there's a lot of adjustments and things that go on with the official government data. But apparently, the reporting so far on Amazon Prime Day this year is that it's down 14% from
Wow.
where it was last year, the spending. It's not over yet, but apparently they're tracking from where we were last year at this time, and we're down about 14%. So that seems to be kind of an indicator that the consumer, yeah, is not feeling that flush these days.
Yeah, well, and that comports with another data point that just hit the tape a little while ago on consumer credit, which is all of the consumer borrowing that is not mortgages. So it's auto loans, credit card loans, student loans. And what we saw is that credit card borrowing actually declined. And I think it posted its second largest decline since COVID. It's very unusual for credit card borrowing to actually go negative. And obviously, you'll recall that it did that during COVID just because people were getting so much money from the government. They were actually smartly paying down
Paying
their
it
credit
down,
card
yeah.
balance. So, but that's obviously not the case right now. And as you and I talked about, I think the last time we got together, the student loan payments are resuming, and they actually resumed May 5th. So I don't know why they picked Cinco de Mayo. That's like blasphemy as far as I'm concerned. But so I think we might be starting to see the impact of those payments on other forms of credit because, as we also talked about, you know, you face wage garnishment if you don't pay your student loans. And in
Right.
fact, I read one study that suggested that 2 million student loan borrowers are presently facing wage garnishment this summer. And the Department of Education is forecasting that that number will rise to 10 million over the next few months. So this is a huge drag on that part of the consumer. And I think that's why we're seeing credit card borrowing being pulled back, and spending, because the credit cards have been the way people have paid for all these goods, the doodads that they're buying on Amazon. So maybe we're going to see a pullback in the retail sales numbers when they come out. I guess that's next week now.
Yeah, I think a great question, to me, I feel the question is why wouldn't we see a pullback in consumer spending for the latter half of this year because of this? I feel like this is something that you, Steph, and I, and a few others have sort of been seeing coming, I think, for a while. And the data that you just mentioned seems to be real validation of this, which is that, yeah, we had a bunch of forms of debt that were in forbearance during COVID, and one by one they've been turned back on, and the student loans were the last one to get turned back on, but they're also the ones that cannot be avoided, right? To your
Yeah.
point, you can't discharge them in bankruptcy, and the government will just garnish your wages, right? If you're delinquent.
Yeah.
So part of me is just wondering, like, why wouldn't this happen? And, what I've learned about student loans is that when they go delinquent, they're uh, when they're declared delinquent, notice goes out to the credit reporting agencies,
Mm.
right? And so you see a pretty dramatic hit from this delinquency because they don't report it. I can't remember how many weeks or months that you have to be delinquent before it's actually reported. But once it is, it's a pretty big ding to your credit report. So all of a sudden, you have less money left over to pay your other debts with because the government's getting its pound of flesh. But also your ability to take on any more credit or get any more credit goes down because your credit, and if you're taking on, more debt going forward, that debt's going to be more expensive because you're having to pay a higher rate on it.
Right. And importantly, it's going to compromise your ability to buy a new home, to qualify for
Hmm.
a mortgage. And that obviously, housing is crucial to the economy in general. So that's a huge one. I mean, it's something to talk about consumers buying less stuff on Amazon, and, not helping Jeff Bezos pay for his $50 million wedding. But it's something else if they suddenly say, we can't afford to buy that new home. That the knock-on consequences of that obviously are much more significant, the multiplier effect of that on the economy. So I think this student loan thing, and I know we've talked about that before and you've heard it from other people, could be sort of the catalyst for a broader slowdown in the consumer, or let me put it differently, for the recognition that the consumer really hasn't been that strong and that it has strictly been this forbearance and the ability to kind of go through buy now, pay later and move credit from here to there, that's now being compromised, that really kind of pulls the curtain back and people realize the economy really isn't as strong as popularly imagined. And we face some other headwinds too, like the fact that today, again, we've got 10-year yields back over 440. So, I know I'm dancing all over here, but kind of weaving that back to the housing thing. There's the Atlanta Fed has an interactive housing affordability portal, and it walks you through the affordability index. And right now, I guess, housing expenditures take up 46 of the median household budget, 46% of the median household budget. And the appropriate threshold, they say, is 30%.
Right.
If you do the math on that and assume that home prices don't go anywhere, so let's assume no one goes into negative equity and your home price stays where it is, mortgage rates would have to go from 6.7% today to 4%. So
Wow.
yeah, it's massive. Rates would have to come down so much, and way more than the markets are presently expecting rates will come down, in order to kind of loosen the vice grip on the housing market, either that or home prices will have to come down a lot. So you're looking at two kind of dire alternatives to get that market opened up again.
Wow. So yeah, 6.7 to 4%. So that's not happening anytime soon. It's going to take
Right.
a long time for that to happen, unless we could get there quickly, but we'd only get there quickly if a
If
really
there's
bad recession. So it's
a
not good
catastrophe.
conditions that would, right? Yeah.
Exactly. Exactly. I mean, that's the
Um,
thing. Like the alternatives right now are uninspiring. Either rates come down because we have this complete collapse in economic activity, and that reflexively sows the seeds of a decline in interest rates, or interest rates stay where they are. And what happens? Do we have to have more big, beautiful bills and actual fiscal stimulus like we had during COVID to support and sustain growth and asset prices at their current levels? In that case, we're talking about a massive decline in the dollar. So whether it's interest rates that are going to have to move or the dollar is going to have to move, we clearly one or the other is going to be a real disaster, because I don't see any other way we can worm our way out of this scenario.
no, I mean, except at least specific to housing, the other way to work ourselves out of this, which I think is the most likely way, is that prices are going to come down
Right.
substantially, right?
Yeah.
Which I think you share that opinion.
Yeah.
Yeah. And
And that,
by the way, I do want to ask you about the dollar in a bit, so folks don't think we're forgetting about that.
sorry, I'm just bouncing all over. So
No, no,
that's
no, no, it's great.
stream of consciousness style today.
No, 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 no. You're hitting all the highlights. So a couple of points on this same topic of consumer spending. Um, First off, there's a concept that I read. I think I first heard about it from Charles Hugh Smith back kind of around the GFC, maybe even right before the GFC. But it's this concept of called debt saturation, which the consumer just gets to a point where they've taken out so much debt they can't take any more out for one of two reasons. If I take on any more debt, then I just can't service the debts I already have, right? Which honestly, when you're at that state, you're not even thinking that way, right? You're just trying to get as much debt as you can to pay whatever bills are screaming loudest, right? And then the second way you hit debt saturation is you just can't get any more credit because they won't give it to you. They're just looking at your situation and saying, okay, no mas, we're cutting you off. Do you feel like we're getting close to that level here based upon what you're seeing in the consumer credit? The fact that people are now getting into trouble with their student loans going to repayment and they're having to kind of steal, borrow from Peter to pay Paul, sort of with their other forms of consumer credit?
Well, I mean, I think we've been tiptoeing into this for quite a while, and that was what gave rise to this buy now, pay later phenomenon,
Hmm.
which just exploded because, there was this idea, the beauty, I think, of the buy now, pay later, in addition to, being able to put, a fraction down on whatever it was that you were trying to buy, these layaway things, is that no one was reporting the data to the credit agencies. So if you fell behind on your buy now, pay later payments, it wasn't hurting you in any way. It wasn't like all of a sudden you weren't going to be able to, they were going to lower your credit limit on your credit card, or it was going to affect you getting a mortgage or anything like that. They are now starting to report that. I think Equifax or TransUnion, a couple of the big credit agencies, are now collecting data on buy now, pay later. So I think that we've been kind of moving in this direction toward debt saturation where people are just getting more and more desperate. And I think buy now, pay later probably came about after the post GFC, the Consumer Finance, whatever Bureau, the
Right, the
CFPB,
protection. Yeah.
tried it right to do away with, really clamped down on the payday lending industry. And I think that kind of, as all these things do, kind of opens the door to some new novel way to basically lend money to people who are so distressed that they wouldn't otherwise be able to get access to credit, much the same way that in the corporate market, they are now, instead of banks giving them the money, they're going, getting money from
Private credit.
credit. So These are all
I'm curious on that. I mean, do you think there's kind of a tranche of the private credit world that is the version of corporate buy now, pay later?
100%. And it's kind of the same situation where you can only go by the anecdotes because there is no hard data that is
Right.
tracking it. But, I talk to people who are in or know people who are in that space, and the stories are just horrifying. There's eh, from companies that are basically just garbage, and they just keep doing they find all these ways to basically subordinate the new debt, and they're constantly like piling debt on top of debt on top of debt. And you wonder, at what point do the people who were senior, who are now getting junior and getting pushed
Hmm.
farther and farther down on the chain, stand up and say, we're not going to take it anymore. But so far they seem to be able to play these games. But the real sign that we're reaching that point where the jig is up is this push to bring access to retail investors via ETFs.
Right.
It's
Right.
like we've got to find some patsy.
Some patsy to
We
dump our
right, we
junk
burned
onto.
through the pensions and the insurers and the endowments, so now we're going to go to retail, and that's pretty much where we are.
That's probably, I've been saying for a while now that the most predictable headline of the future is oh my gosh, who could have foreseen how badly the buy now, pay later loans have performed, right? But
Right.
probably the second most predictable one will probably be oh my gosh, the private equity, the taking private equity to the public markets ended poorly. Whoever could have seen that one?
Right. Yeah. No, I mean, I'm what do you say, shocked? What is the thing from Casablanca?
Yeah, I'm shocked to discover that
Shocked.
gambling's been going on here. Yeah.
No.
Classic Frenchie. All right. Well, look, so let me share this uh, chart and then I'll get to my big question on this topic. So, one of the things that has kept consumer spending, looking okay up to now has been the strength of the affluent consumer, right? So, they're punching way above their weight in terms of their spending. And so they've been keeping the average looking okay, right? So I just saw this tweet from Mark Zandi, who's a very conventional economist. He definitely, I would say, tends to be much more on the bullish side generally. But he says here, consumers have been cautious since the start of the year. After inflation, consumer spending has gone sideways. That's because of the well-to-do, those in the top 20% of the income distribution who account for 50% of spending. They had powered spending coming out of the pandemic, but not recently, right? So I guess one big question here, Steph, is are we starting to see that engine of consumer spending, the affluent consumer, start to run out of steam here? And if it does, what does that portend for the future?
Obviously, that would be huge because the high end drives all of marginal consumption. But it seems like this is probably very much related to the, let's call it, volatility in the stock market, basically since the tariff
Hmm.
diplomacy, should we call it that, was unveiled in April. And I mean, the market's recovered a lot, but it's still bouncing around. It's kind of you need a little Pepto-Bismol, and the last couple of days have been challenging as we go back to this idea that we're going to have higher tariffs on some of our important trade partners, and then copper tariffs today at 50%, which is obviously a hair-raising number. So I think that a lot of this is kind of an indication of a little bit of a reverse wealth effect, despite the fact that we really haven't seen much of a decline in the net worth of that high-end constituent, which kind of is foreboding when you think about the prospect of what would happen if the market actually did have a serious correction and sustained it, didn't immediately bounce back.
Hmm.
That would have a more durable impact on the economy. But at the end of the day, I mean, ultimately, it's going to be housing that's going to be so much more impactful because it does affect such a larger swath of consumers and has that real multiplier effect throughout the economy in terms of construction and refurbishing and appliances. I mean, there's so many things that happen when you buy a house that just multiply through the economy. But to your question on the high end, I mean, clearly we're starting to see some signs of slowdown there, but I don't know that we need to see the high end crack to necessarily ratify this consumer recession story. In Mark Zandi's chart, he only goes back to the beginning of the year. You and I have been talking about this, but in real
I know.
terms, retail sales have gone nowhere for 3 or 4 years. I mean, I want to say it's 4 years now. So broadly speaking, the consumer has been in recession. And now maybe the high end is starting to cool it a little bit, but there's really nothing has changed fundamentally in terms of the weakness of the average consumer.
Yeah, well, I mean, I think, and especially from our conversations, I think the average consumer has been getting worse, right? Their trajectory has been worsening. And to my point, what's been keeping things looking normal or fine, air
Right.
quotes, has been that, I mean, honestly, that upper half of the K in this K-shaped economy, right?
Yeah.
And it seems like the bottom half of the K has been getting bigger, over the past couple of years. So to your point there, Steph, I think that there's people for years now who have been reporting, hey, I don't care what GDP growth was this quarter. I feel like I'm in a recession, right?
Yeah.
And I think the number of people saying that has been growing. But what's
Mhm.
been keeping everything looking fine is that strength of the upper half of the K. If that starts cooling, that could be the thing that really starts making it look like the majority is now in a recession. So
Yeah.
who knows where that's going to go? We'll see. I think it's notable that we're seeing, I don't want to say a contraction of spending in that group yet, but certainly as Andy says, it's cooling, right?
Yeah.
Um,
I think what we're discussing here is, when I characterize nothing has changed for the average consumer, I mean that it's bad and it continues to get worse. Like
yes,
they're just getting
yes,
deeper. But I think what we're distinguishing between is the perceptions about the economy on Wall Street versus the perceptions about the economy on Main Street. And Wall Street has been diluted by that higher end that's been sustaining the average statistics that they all look at their headline scanners and they see, consumer spending broadly is up. And they don't do the analysis, that some of us are doing that shows that the only thing that's up in consumer spending is insurance, healthcare,
right.
food, all the things people can't live without. And when you strip that stuff away, they're actually slowing their spending. So I think it's maybe we're going to start to see this situation where Main Street and Wall Street's perceptions come to meet. And they're not going to meet, in my view, by Main Street's perceptions about the economy improving. It's going to be Wall Street's coming down to the reality that has been the reality for going on 4 years now.
Well, so I share that point of view, and here's where I'm taking this. And by the way, it's not just investors on Wall Street that are looking at those averages and saying everything looks great, but it does seem to be policymakers as well, right? You hear
Yeah.
Jerome Powell talk, and he's hey, everything's pretty good, right? So we have this big disconnect, I think, between the theoretical and the casino of Wall Street versus the regular guy just living his life out there. Here's where I'm going with all this, which is I think I've mentioned this before, but I'm going to ask you it again. I just recorded an interview with Michael Kantrowitz, and he's got the HOPE framework, housing, orders, profits, employment. And I think it's a great framework because historically it really does sort of show you how the dominoes fall as you're going into recession. It actually shows you the progression, how we come out of recession too. Housing usually leads out too. But he's been transparent in saying, this current era that we've been in, it's we're seeing a lot of things for the first time that make it hard for him to say, oh yeah, I have a lot of confidence we're headed in this direction or that direction. We've really kind of been trending sideways a lot by many of his indicators. And so he basically was saying, look, I don't see enough here to be able to say we're going into recession anytime soon. I'm not saying we couldn't, but I'm just not seeing in the indicators yet that like the warning signs that I'd be looking for are going off here. And so he said, I think if it were to happen, it's going to have to be something that kind of catches us by surprise. It's something that the market's not seeing yet, and it's something that we watching all these indicators, it's not currently burning brightly on our radar. It's going to be something that kind of comes out of the blue, right? And I'm just wondering, could subprime, like going into the global financial crisis, it was the subprime loans that just everybody thought they weren't as risky as they were, and they started blowing up, and that was the thing that caught everybody by surprise. Could student loans be that first domino that sets off a credit contagion here? Because I for everything that we're talking about here, I can see that, okay, people all of a sudden, a lot of people can't make their student loan payments, and they're getting garnished and whatnot. Okay, well then now they're starting to default on other loans, and man, now their credit scores are getting dinged, and okay, now they're defaulting on all sorts of things, and the consumer spending's going down, and that's starting to bring down corporate profits. And when I talked to Anna Wong of Bloomberg Economics about this, she had this concern, and along with it was a sense that, hey, the whole lending industry, in her mind, is looking at people's current credit scores, and they've kind of become grade inflated since the global financial crisis. And once they wake up to the fact that, like, wow, people weren't as creditworthy as we thought, and to your point, Steph, like, oh my gosh, we weren't taking buy now, pay later into account, and now that we're seeing what that looks like, oh my gosh, like we never would have loaned this much to these people, right? Could that be collectively big enough to be something that could then be the shock that the system says, whoa, wait a second, we didn't have this priced into the markets, we as lenders didn't, and we have to really constrain our credit standards, and then consumer spending gets hit, and then that pulls everything down with it.
Absolutely. And it doesn't even have to be some spectacular crash. We don't have to have all of a sudden, the wheels fall off and we have a 2008 scenario all over again. If you just think about what we have been doing over the last several years is just grinding lower and lower and lower, and seeing credit quality deteriorate more and more and more, and the consumer's capacity to spend be further compromised. And so what you're talking about is an environment where, let's say, credit card delinquencies go up, and as we saw today, they have to cut back on running up the plastic. Well, the next thing they're going to have to do is stop spending so much, because they were using the plastic because they didn't have enough cash with which to purchase those things. So spending will slow, which means corporate profits will slow, which will slow employment, going through the whole hope thing. And that will steadily grind on to the point that the economy will lapse into recession. And so whether it's a spectacular economic crunch that falls around a credit bust, whether it's an eye-opening awakening that, yes, let's say credit card delinquencies go well above where they were in 2008, or, and banks are on the hook for it, or, any scenario is possible as relates to the subprime, let's say, consumer or subprime student loan, and how that could precipitate a risk-off attitude in the credit markets, which itself would lock down the economy, because credit obviously is the fuel that drives the U.S. economy. So whether it's a spectacular immediate collapse like it was in 2008 that's precipitated by some credit bust, or it's this continued slow grind lower and lower, I think the outcome is still the same. We're talking about an environment where ultimately fiscal policy is going to have to be brought to bear to right the economy, because, and I think this is what we're seeing today, The markets are going to do to Jay Powell what they did to him in September if the Fed cuts rates in July. And that is that he will cut the Fed funds rate and the 10-year yield will go up rather than down. Because I think clearly the markets right now, just reading the tape, seem to believe that this is not a backdrop against which the Fed really needs to be cutting rates, because they probably believe this sort of narrative that the consumer or the economy broadly is stronger than it is. And there's a handful, a pretty decent sized constituent that fears inflation from the tariffs. And then there's the overwhelming majority of people who are concerned about the fiscal situation and the idea that if the economy slows, the deficit's just going to get much, much bigger. And then how are we going to finance that? So it seems to me like we're in an environment where this whole hubbub about the Fed cutting rates is sort of entertainment, because if they cut rates, I don't really see it having a significant impact. I think we're at the point now where it's really going to come back to fiscal to right size the economy if we have a downturn, whether it's a spectacular collapse or the steady grind. And I will say that, I had been in the spectacular collapse camp for a long, long time, and maybe that's going to happen because now this big, beautiful bill makes me think maybe we're going to have to do another stretch of this grind, because now you've got you've got some tax breaks that we didn't have before. We've got the depreciation and CapEx, incentives for capital spending that will help offset or at least delay some of this pain, or let's say extend it out a little bit farther. But you're still going to be competing with a slowing consumer, slowing consumer spending, on the back of these credit issues and the desperate efforts to sustain the debt service, which is, I had some charts on that and I wish I had put them up. I guess I can give them to you after the fact, and maybe you can post them, Adam,
Absolutely.
from my missive to clients today, that just shows household interest payments, their interest expense. And it's, an all-time record high, not surprisingly. But even relative to disposable income, it's getting very extended. So oftentimes you hear people dismiss the interest expense by household saying, yeah, but income's gone up so much that really it's not unmanageable. And it looks like we're really starting to push into territory where it does become problematic, levels that we've seen at prior recessions. So I do think that this consumer slowdown is just going to continue to grind on, notwithstanding the big, beautiful bill. And that eventually people are going to do the math and say, look, there's no end to these $3 trillion deficits in sight. And that's really our issue, is that we're stuck in this environment where long rates really don't have much room to come down, regardless of what happens to the economy, and the deficits aren't going to come down. And how do we navigate that from an investment standpoint? I think that's really the big question.
Okay, well, we'll get to that. So I'm sure folks are dying to hear your answer to that question, and I'm sure gold plays a role in that. So some great points there, and some interesting questions that come out of what you just said there, Steph. But what I hear you saying is look, the thing that tips us into or that drives us into recession doesn't have to be a fast motion train wreck. It can be a slow motion train wreck. Both are still train wrecks, right? They still get you to the same place. And I think that recency bias, whatever you want to call it, investors, the markets have said, yeah. I've heard people chattering that the consumer is struggling, but we've been hearing that for years now. The headline data still looks good. Like I'm not worried about that anymore. And actually talking to Michael Kantrowitz earlier today, he has a chart up there and he basically shows how the market is discounting macro risk to an extreme right now. And, those are the times where the market is more prone to reacting more violently to surprising news just because it right now is kind of priced for perfection, right? But okay, yeah, I think you answered my question, which is, could the kind of drip, drip, drip of this slow motion train wreck of just the worsening consumer for all these credit reasons we're talking about, could that get us to the point of breakage? It sounds like you think yes. Who knows how long it's going to take? We don't know. You think that that's going to be met with a lot of fiscal response at the end? I don't disagree with that at all.
Yeah.
But you raised an interesting point, which is we just had the passage of the one big beautiful bill. It does have a lot of, I mean, it's a big important pillar of Trump's policy platform, and there is a lot in there that will goose economic growth
Mhm.
and will support consumer spending. Some of these tax breaks that you mentioned, as well as a bunch of big investments. What's kind of interesting about this is I want to ask you, so what do you think the likelihood of the midterms is going to be in terms of where the votes go? Because, we had talked at one point, Steph, that like if the administration had kind of let a recession happen early on,
Mhm.
you could get hopefully the worst of the excesses behind you and then be showing an upward trajectory heading into the midterms and maybe, keep enough people with you to say, okay, this looks like it's headed in the right direction. I'll vote for you again. Versus now, it sounds like this is just going to kind of let things persist kind of the way they are, right? It might retard the pace of decline, but it's
Mhm.
probably not going to dramatically accelerate unless you think differently. A new era of prosperity in time, at least, for people to feel, that bottom half of the K, which is the much bigger than the top half.
Right.
They're probably still feeling like, "Well, I still kind of feel like I'm in a, personal recession here." That doesn't bode well for the incumbent come the midterms, correct?
Yeah, no, it's definitely a risk for sure. And I think you're right. There are a lot of things there that are supportive of the consumer, um, and should help, obviously. Um, but I guess really it's hard to answer this question without getting too political. But part of it is also going to depend, what does the other party propose as the alternative? So when you look at some of the ratings, at least on things like the immigration policy, people are still very, very supportive of the administration. So I think the economy would have to weaken significantly to change the current sort of path, which seems to be that they should do okay in the midterms. I mean, I don't, it's historically the incumbent always loses some.
Right.
So I'm not saying that they'll pick up seats. I'm just saying maybe the loss won't be as bad as, let's say, it was during Obama, where he confessed that he was shellacked. Wasn't that the word he used?
Yeah.
So, but it really depends. And, it's hard. Timing is impossible, as you know. Um, I keep coming back to what happens to the bond market because I feel like that's really the tail wagging the dog. And everyone's looking over here at the tariff headlines and moving around and reacting to every, first he goes with a big number and the market sells off, and then they make an agreement and it's half of the number that the headline suggested, and then the market rallies back. And in the meantime, in the background, the real existential threat to the economy, which is rates staying at this level, continues, and it doesn't seem to be getting that kind of attention. I did a chart, and I don't know what possessed me to do it, just looking at the 10-year yield, and I laid on top the 3 and 4 year moving averages of the 10-year to see if we had ever had a period where rates, after coming down, went up and stayed this far above their 3 and 4 year averages for this length of time. And we've never stayed this high for this length of time.
Hmm.
When we've come close to it, you will not be surprised to learn a lot of very unpleasant things have happened. Like,
Happened. And sorry, how long was your data series?
it went back to 85, basically. So I captured 87, 1990, 1994, which was a stealth bear market for stocks,
Yeah.
1999, 2000, 2007. So basically, through the entire period that we've been levering up the economy, um, obviously, and not surprisingly, each time rates move back up and stay up, it's just a matter of time before something breaks.
Something breaks. Yeah. Interesting. Reason why I asked how far you went back was so obviously we were in a bond bull market, right, of just secularly lowering interest rates from the early 80s until 2021. Um, I guess we could look at your data and say either it suggests that we're at an extreme that has to correct because they've corrected at every point in the data series, or we're in this new regime where rates are going to go kind of ever higher for the next couple of decades, as many are predicting. But to your point, there are, higher interest rates are just increased gravity on economic growth. At some point, they just, things buckle if they're too high for too long.
Yeah, and that brings me back to something I wanted to chime in on when you were talking about the precipitating the recession and how that would unfold. And I guess my feeling is the slow train versus the fast train, it's still a train wreck.
Yeah.
Is that the way I see it sort of unfolding is that we continue to grind lower and lower on the consumer to the point that it creates a little bit of a credit panic where credit risk is repriced across the entire credit market. So not just
Mhm.
in the consumer segment, much less in just the student loans, consumer segment, but eventually people start to say, oh, look, these people got sloppy with their underwriting standards on that one facet of consumer debt. Maybe they did it with all consumer debt. And if they did that with consumer debt, maybe corporate debt, and all of a sudden
Yeah.
what happened in 2008-9 is actually you had the economy, consumer was in recession in 2007. And it took a long time for the markets to begin to reprice the credit risk. Then you had the spectacular credit bust, which then exacerbated the existing recession and made it even worse. So you have first the average consumers in recession, then the credit bust follows on that, and then you kill the high end because the credit bust crushes their net worth via both housing and especially all the risk asset stocks, especially. And that causes a reverse wealth effect that makes the recession even deeper until, of course, they come running in with the fire hoses.
So you just did a really good job of articulating what my fear is. Personally, that's kind of what I think is maybe the higher likelihood, or maybe I would say has been the higher likelihood risk here, is it's the slow motion train wreck that just eventually gets to the point where, again, I use that word contagion, right? Oh, student loan debts look bad. Oh, but then maybe all credit loans, all consumer credit loans look bad. Oh, well, then maybe all loans are bad, like even the corporate ones, right? Um, so, Steph, if I'm, you know, on Scott Bessent's team here, I'm saying to you, well, Stephanie, yeah, I understand your logic, but look, we are putting in place a lot of new engines for growth. They're going to turbocharge economic growth, and even if it takes a deficit a while to come back down, its percentages of GDP is going to get lower and lower, and that's actually going to strengthen the economy. And we're going to be creating new jobs, and we're going to be rebuilding the electric grid, and there's going to be all sorts of jobs to hire new people for and stuff like that. So they're going to say this is not a problem. Like everything we're doing here is we sort of see that risk, and everything we're doing here is putting additional fuel and additional pistons, in the engine of America. What would you say to that?
Well, I guess I would say, I mean, those are all wonderful things. I'm a huge fan of all of the real pro-business, pro-America, let's give Main Street a chance for once policy. I couldn't be more enthusiastic about that. But at the risk of being like a terrier on a pant leg with this, I feel like the bond market is still the thing. It's the bugaboo that just won't go away. So you can
Hmm.
do all those wonderful things, but you still have to deal with the problem that consumers, the average consumers, are going to get no relief from the oppressive level of, what is it, 23% credit card rates on average, nearly 7% mortgage rates, auto loan rates, again, back to where they were at the highs prior, and then student loan issues. So I just feel like there's no relief coming there. Then remember, and we've talked about this a million times before, that we're now 3 years into the extend and pretend on the corporate side.
Right.
Those loans have just been, I mean, they just keep restructuring, and basically diluting the borrowers each time. And based on what's happening with the consumer, you have to presume that the earnings prospects of the underlying companies aren't really improving very much. So what's the statute of limitations on the patience for that? As I said, that's what possessed me to do that 3 and 4 year moving average on the
Right.
bond market, was to try to figure out, like, is this typical? Like, can we play this game forever? So who knows? But one thing that I think is interesting is that Bessent is a smart guy. So he's doing some things that address my concern. I don't think they're sufficient, but he is trying. Like, you'll recognize that he has continued Yellen's program of financing the deficits with T-bills,
Yep.
because I think they acknowledge that with rates where they are presently, and Trump even said that in an interview a week ago with Maria Bartiromo, he said, we're going to keep borrowing short because we need
Right.
to get a new Fed chairman in there who will cut rates, and then we'll be able to do more. But at the same time, they're advocating these other things like the stablecoin reserve, which would basically function as a massive money market fund to sop up T-bill issuance. So they're trying to come up with little games that will help manage us from here to there, on the assumption, and it's the same assumption that the extend and pretend guys and everyone else is operating on, that long rates are going to come down. And I'm just trying to figure out how that magic happens, given the fact that right now we're seeing long rates that refuse to bend at all, and we've seen inflation slow dramatically. We're racking up these wins around the world. And if people felt like the big beautiful bill was going to stimulate enough growth to help us grow into the deficit, you'd think that would help alleviate some of the concerns at the long end of the bond curve.
Yeah, those are all great points. And, one could say, well, look, the administration's still young, so you got to give them time. But, from very early on, they said really one of their topmost priorities was to get the tenure down. And to your point, they just haven't been able to get any traction there. Every time they do, it just bounces right back up.
The other thing that is interesting, and I may be not giving them enough time on this, but oil. So, they wanted to get oil prices down, and retail gasoline prices have come down. But here we are. OPEC just agreed to increase production, and oil is $68 a barrel. It hasn't gone lower on that headline. So I don't know. I mean, that's another one that's sticky in a way that they don't want it to be sticky. And I think imagined it would come down. But I know there's a lot of promotion of domestic production that has yet to necessarily kick in, that might help that going forward. But so far, tap, tap, tap.
Yeah, yeah. Oh, it's interesting, uh, you know, s- it- oil with a six handle, I think in general is considered to be relatively affordable, right? They say like 70, historically I've heard 70 is sort of in the sweet spot, right? That's where the producers can make enough money that they're happy. But if it gets much higher than that, it starts impacting economic growth. And if it drops much below 70, then the producers start having a disincentive to produce because they're not making as much profit. And I think oil has been, relative to the past couple of years, oil's been in a much more welcome band, right? So I don't know. We'll see.
Absolutely.
I'm no oil expert except to say I just released this morning, Steph,
The
interview
Doomberg.
with with Doomberg, yeah, who
Yeah.
thinks that like the new like equilibrium price for oil is like $50,
Uh-huh.
which wow. And he's got a good rationale for that. I won't go into that here just so we can stay on point here.
I'm
So
just
Steph,
mentioning it
good.
as relates to the consumer because if they're stretched already, they need to get their gasoline prices down significantly. And, they're down a little, well, what, 15 cents or something like that. Retail gasoline prices just haven't come down enough to really be a source of relief for the consumer that would offset, let's say, the burden of rates that refuse to come lower.
Right. Well, so you had put out a tweet, Steph, before we got on here, asking your followers, hey, what questions would you like us to address? And one of them, this whole discussion about higher rates, right? That they've been hanging around for a lot longer than anybody thought or wanted, right? So their question is, well, Steph, if higher rates, are such a big issue, why aren't they hurting the economy? Like, right? So what is your answer to that?
Well, I mean, my answer is obviously they have been hurting the economy.
Right. And more sort of, hey, just wait, right? Like,
Yes. Well,
it'll become more visible.
exactly. That's the word to use. Like it has been hurting the economy. It's just that the constituents that it's been hurting aren't in the front and center stage. They're more, it's the weak links in the chain that have already broken, and we're waiting for that to kind of move farther in. Obviously, we've got, I don't need to recite all the, credit card delinquency rates highest since the global financial crisis, and then the largest wave of corporate bankruptcy filings since that period as well. So it's not like no one's feeling the pain of higher rates. There's been a ton of pain. We also had SVB. I mean, it's so long ago now, people forget. But
Everyone's forgotten. Ancient history.
and related to that, the banks are still sitting on almost $500 billion worth of unrealized losses on their safe treasury and agency holdings. So there has been a lot of pain. There's just been a lot of, uh, let's say, uh, things that were able to prolong the perception that things are, that we're kind of muddling through. Let's say we've been able to, on average, in the aggregate, consumers have been able to muddle through because, as you mentioned, you've got the high end that's kind of masking what's happening, all the distress at the low end. And the same is true in the corporate sphere, probably even more dramatically. You've got a huge swath of companies that just went belly up. And then you've got 7 companies, the Mag 7, that were all the rage and were inflating all the averages. So I think we've had this environment where the top of the tip of the iceberg has captured all the attention, and everyone's just like blissfully unaware that there's this massive block underneath that is really struggling.
Got it. Yeah. To use an analogy that you use a lot about bodies floating to the surface. Nobody really notices the guppies or the sardines when they float up to the surface. They only notice the whales, right? But right now we're not at that point yet, right? Where the fish that have been dying and floating to the surface have been smaller. So I assume, but don't let me put words in your mouth. You think as we progress along here, we're going to get to a point where some of these bodies that start floating to the surface are big enough that the media either has to pay attention, can't deny or whatever, but that may be what begins to sort of change sentiment that like, whoa, if that's, almost kind of like a Bear
I
Stearns,
was
like,
just going to say that the Bear
yeah,
Stearns moment, we'll have something like that. And as Michael Cantorowitz was saying, it's probably, he was saying that about the economy, but I would say it about the credit bust. It's probably going to be something that none of us really have on our radar. It might be some private equity firm, who knows? It could be a bank again. It could be anything that suddenly captures everyone's attention and precipitates this broader repricing of credit risk. I mean, the one thing I will say about the credit markets is that risk appetite, I like to describe it as a light switch. It's not a dimmer.
it's
It's
not a dimmer.
on
Yeah.
or off. There is no, oh, there's a little less rabid risk appetite. It's cooling a little, it's warming. No, it's on or it's off. And you flip in an instant. And that's what happened in 2008. And so I do think that's what we will probably see again. And then that will help everyone realize that fundamentally underneath it, the economy really wasn't that strong to begin with. And this credit bust will just kind of feed on itself on the downside.
And that's something that I really hope that the listeners here just really let sink in. You and I have just gone through a long litany of risks, right? Do they manifest the way in which we fear they might? Who knows, Stephanie, right? But right now, what are credit spreads doing?
I mean,
They're super
they're
tight,
terrible.
right?
Yeah, exactly. I mean, risk is on. The
Yeah,
light switch is
the
on.
switch to your point is flipped on, right? And so, yeah, it's not. People oftentimes say, "Look, it can't be that bad," because if it was bad, they would be telling us what they're seeing and that it's coming and whatnot. There doesn't seem to be a mechanism like that in the markets anymore about credit appetite. To your point, it's either like everything's great and we're pedal to the metal, or we're jamming on the brakes.
Right. And they, to the extent there's a they, have no incentive to tell you what they're
Right.
seeing. You know,
Yeah.
the objective is to hide everything that you're seeing. No one's gonna come forward and say, yeah, I work at a private equity shop and 80% of our portfolio companies are bankrupt.
Right.
They're not going to come out and tell you that.
Right. Well, th those who saw Margin Call, right? What was I'm
Right.
trying to remember which character Jeremy Irons played, but he was one of the first to really cotton on to what was happening. And what did he do? Said, sell everything. We want to be the first one out the door, right? So just
Yeah.
tell everybody everything's great. Take these assets, they're awesome, so that when
Nice.
everybody wakes up and realizes what's going on, we're out.
Again, it's the retail ETF. Here you go, people. You got to get some of this. You're missing out on all this wonderful stuff that the sophisticated investors have been able to get access to. Now we're going to give you an opportunity to get in.
So
Oh,
I got to say, and I don't want to make this political or partisan, but I just saw a headline before we got on here about the Trump organization, family, whatever, Trump business is just announced an ETF that's going to be, owning a certain percentage of these various different cryptos. And
okay.
I don't know, it just kind of smells like, you know what? Now is
Yeah.
your chance to, it really does seem like it wouldn't surprise me if we look back and say that was a top tick of the
Yeah.
market.
100%. 100%.
So let me ask you this question that I asked Michael, and sadly I asked Michael after we had turned off the camera. So folks, it's not in my interview with him that's coming out in a couple of days. Um, but we were talking about this bifurcation in the economy and this, it's happening within industries, it's happening with companies within industries, right? The Mag 7, these hyper growth, hyperscalers, they're just getting more and more of the pie, right? But the same thing's happening in the retail side, the consumer side, right? As we've talked about.
Oh, I'm sorry.
Uh,
Oh, hi.
no, I'm trying to say this pithily, trying to find a pithy way to say this, but are we um are we sort of, I don't want to use the word condemned, but like, are we heading towards an inexorable outcome here where, America essentially becomes like an aristocracy, right? Where we just have a small number of households that own pretty much all the assets, financial and otherwise. The markets might still be doing fine because there's, a few hyperscalers who are doing fantastic that are keeping the averages up, and most of their shares are owned by this top 10% anyways. And that everybody else is pushed further and further into a servitude to just
Hmm.
a subsistence servitude just to keep the system going.
Well,
It sounds super dark.
I was going to say that's dark even for me.
Yeah.
Um, this is where people will laugh. I think I'm optimistic, and I'm optimistic because I think that we're going to have a cleansing downturn that removes that possibility, that it's an equalizing situation where suddenly, you finally, if we had the stock market return to anything resembling, average valuations, historical valuations, the high end would be absolutely destroyed. You
Mhm.
know, I mean, they'd be fine, but psychologically they would be destroyed. And in terms of, they'd come down a lot in terms of the skew between the high end and the average consumer. Um, there would still be wealthy people and they wouldn't have trouble paying their bills and whatnot, but they just wouldn't be obscenely wealthy while the average person is barely getting by. So I think you would
We'd
narrow.
have a lot less $50 million birthday parties.
Oh, yes, exactly, exactly. So I think that I'm optimistic that you will have a period where a Main Street does, Wall Street and Main Street, I'm using Wall Street to define sort of the higher end elite,
Yep.
um, that they move closer together. And initially, that move is going to happen by the Wall Street constituent coming down. And then eventually, when we get through that awful gut wrenching downturn, I think we'll be able to reset the table in a way where it's, everyone is on a little bit more of an even footing. But I'm a capitalist, so I don't think that we should be trying to have an environment where everyone is even. There's people should be rewarded for taking
Right.
risk and working harder, and people should be penalized for not taking risk and not working hard or not working at all. And so I'm not advocating for some system where everyone is, great on some, average level income. But I do think we'll narrow that K shape will move back to something more normal. But it's going to take a long time. I mean, I can't imagine aristocracy and all of that. I mean, I think we're pretty much as far at that extreme already when you think about, um, I mean, I don't want to use the phrase deep state, but there's an entrenched Washington elite that has been leading the country, and there's an entrenched corporate elite. You have these CEOs who leave one major corporation and they go and work at another
Yeah.
corporation. They
No, I
make,
mean, this is called corporatism or crony capitalism. And I think a lot of viewers would say, yeah, we get it, Steph. Yeah.
yeah. So, I mean, I'm optimistic that it would just take a really good, healthy, deep recession to put us back on a track to kind of reset uh, the economy and the whole political framework and social framework to one where we can start on a much stronger footing and everyone have an equal opportunity to succeed.
So let me ask you about that then. And Steph, I think there's a lot of people who would root for that. Um, and it's a strange way to say it just because, we the last time we kind of went through the process you're talking about, was the Great Depression, which even if you're feeling good about it kind of bringing the classes maybe back into better balance, is not a fun
It's
process,
a
right?
gut wrenching. Yeah.
Yeah, nobody's having a good time.
No.
Um, and it's funny, like it's a market-driven solution to what I think a lot of like democratic socialists, an outcome that democratic socialists would cheer for, right? Now they want to do it by different means, but it's
Right.
like, hey, if you want to get, wealth inequality to be more fair, that's definitely a way to do it, and it's a market mechanism which you and I as capitalists are in favor of. Now, help square this for me, Steph. So let's say that happens, right? Let's say that there is the market clearing event. How you talked earlier about having a lot of confidence that the fiscal rescuers would come into the mix. So how square that in the sense that the fiscal rescuers don't just come in and do everything they do, just even more so, which to date, every policy step they've taken has supported the current imbalance and rewarded the upper classes, those who own assets.
Yeah, well, I mean, I guess it wouldn't be different in that regard, except the question is, does the market rally? A lot of the reason why that helped support the upper end income is that financial assets have always been prioritized over the economy. It's
Right.
the Federal Reserve has been the tail wagging the dog here. And I mean, what I think has happened and what drove that K-shape, I place all of the blame, and maybe this isn't fair, at the doorstep of the Federal Reserve.
I placed a lot of it there too. Yep.
Yeah, I mean, basically, all they did was try to get, and Greenspan even said this after the housing bubble burst. I mean, basically, the idea was we need to create I'm sorry, after the dot-com bubble burst, and he came in and he cut rates, and he basically said we need to reinflate assets. And that was going to be the solution, because then once you get asset prices up, then, you stimulate high-end consumption, and then businesses start to pick up and hire and expand, and that helps the lower-end consumers. But the key is to get credit and asset prices moving again to kind of pump that market up. So if I'm correct that we've kind of reached the end of the efficacy of that policy, and that the Fed could cut rates in July and long rates wouldn't come down, and the stock market wouldn't necessarily rally on it because long rates don't come down, that we're now moving to a paradigm where fiscal policy is primary and monetary policy really just, to the extent it's useful, is only useful to monetize the expansion of the fiscal spending. So basically, the Federal Reserve, my sense is that the Fed funds rate is far less important or impactful than the balance sheet. And that what will happen is we'll get a massive fiscal stimulus in the throes of this economic downturn, and that the Fed will re-up QE and help monetize a lot of that stimulus so as to at least hold long rates steady, in an environment where rising deficits might otherwise send them higher. And therefore, the fiscal impact is not as overwhelmingly skewed to the high end. Quite the contrary. I would think the fiscal impact might be more targeted, as it was post-COVID, to average Americans. We'll see. And especially under this administration, you'd think, since they've talked about it being Main Street's turn, that would be their focus. But so I guess my sense is that the reason we have the K is the Federal Reserve, and that if the Federal Reserve has now reached the point where everyone knows their bag of tricks and they're not as useful anymore, that it's really going to come down to fiscal. And the way I see that ultimately being resolved is that the dollar pays the price for the sins of all this fiscal spending, to the point that we start to go the way of, let's say, Argentina, where we're printing so much money and the Federal Reserve is just monetizing like crazy, that we end up having to change the monetary regime. We can't have a fiat money regime anymore because the inflation is just too bad. So we end up either, whether it's a direct link to the dollar or a link to commodities or some hard asset basket, but that will change it. And that will be the thing that puts the pin in the bleeding and basically says, all right, we're resetting right here and we're going to start fresh. That's sort of the way I see things playing out in whatever kind of blurry context anyone can decipher from that. But that's my sense as to where we're going.
All right. Well, I really appreciate you kind of going down this rabbit hole with me. And obviously, this is corroboration for why, for the years I've interviewed you, Steph, you've been a big fan of hard assets, and gold, both as a hard asset, but also as a monetary asset, a monetary hedge, basically on that dollar devaluation. But you've also been, advising people to have exposure to currencies, sorry, not currencies, commodities in general, because of presumably what you think here.
Yeah, absolutely. And I know that in the last couple of weeks, we've had a tough time in gold. And I think that a lot of that obviously is just short-term reaction to some of these headlines about the tariffs and whatnot. But interestingly, this week is the BRICS Plus meeting in Rio. So I would expect we'll get some interesting headlines out of that, perhaps revealing a little bit more progress towards their goals of creating a trading bloc with a trading currency, etc. So I think that's important to watch. And generally speaking, I mean, I just think as they have done so far over the last year or longer, that hard assets and gold especially will outperform paper assets. And so call me a bear if you want on stocks. I'm just saying I have something I much prefer to own than that. And I'm sticking with that. So
All right.
I'm
Well,
a broken record, unfortunately, but
no, I mean you're consistent in your logic is how I see it. And also too, like I own a lot of precious metals like you. I think our portfolios probably don't look that dissimilar from each other's. And I obviously want gold to continue to do well, and I think it will. But I will say I don't have a ton of sympathy for those kind of wringing their hands over gold's drop from
oh yeah.
3,400 to 3,300, right?
Right, right.
I'm just looking here at the start of 2024, gold was at $2,000 an ounce, right? I mean, you've had over
Right,
50% appreciation in the past year and a half. Like, cry me a river, right? If
right.
if it's cooling off a little bit here, right? So we just got to keep things in perspective here. That we've had a great run. Nothing goes straight up in a straight line. You kind of want to have periods of cooling off and consolidation because that then sets you up for the next leg higher.
Yeah, and I mean, I only brought that up because I know that if I don't acknowledge that gold has actually been going down for the last week or so, that someone's going to point that out to me
Yeah,
in
no,
the
and I'm
comments.
glad you did. And there's a lot of gold haters that will come on and say, "What are you talking about? Gold's been
Right.
down $100 an ounce, while Bitcoin, has gone up by another 1,000 or whatever." And just like,
Right.
hey, like, look, it's had a fantastic run. The
Yeah.
thing definitely we have to expect some sort of pullbacks here, and this
Yeah.
has been, I would say, minor so far. If this is all we get, it'd be phenomenal.
Yeah.
Um, okay, you also mentioned BRICS. So on the day we're talking, Steph, I think it happened today, maybe it happened yesterday, but President Trump, um, in addition to writing letters to a whole bunch of countries saying, "Hey, look, if we haven't negotiated something better by August 1st, here's the tariff I'm slapping on you."
Uh-huh.
But he also said, "Hey, here's an additional tariff you're going to get if you're, basically part of BRICS."
BRICS was set up to hurt us. BRICS was set up to degenerate our dollar and take our dollar as the standard, take it off as the standard. And that's okay if they want to play that game, but I can play that game too. So anybody that's in BRICS is getting a 10% charge.
Mhm.
So how much of a deterrent do you think the president actually has to try to, you know, take the momentum that's been building in this BRICS coalition and potentially break it up
I mean,
or
maybe I'm
retard it at least?
I guess I feel like not much. They've invested so many years and so much energy in this. And I think for sure in the case of China, they're really playing the long game here. They're not worried about tariffs over the next 3 years. They are worried about the next several decades. And so I don't see any change. And I guess to bolster my view, I would cite what's been going on with the foreign purchases of our treasuries. We had the treasury capital flows data only goes through April, and through the first 4 months of the year that captures, foreign central banks unloaded $110 billion worth of US treasuries. Um, in these 6 weeks that we have data since, they've unloaded treasuries at a pace that is 4 times that.
Oh, wow.
So they're not slowing down their sales, they're accelerating their sales. Now, admittedly, you're telling me a story that just came out today, so we won't see the impact of that in the custody account for a couple weeks yet,
Right.
if it even happens that immediately. But generally speaking, they have been in no way derailed. Trump made these threats on the campaign trail. So it's probably not news to them to hear this. They weren't unaware that this could happen. And as yet, it hasn't shifted their desires to de-dollarize in any way that I can see.
Okay. All right. Well, I makes total sense to me, but we'll be tracking this going forward, folks, and
Yeah,
we'll
I
definitely
think
let you
so.
know what you see. All right, Steph. Well, as is so easy to do with you, we've gone over the hour, so I have to be respectful of your time. In wrapping up, is there anything that I haven't asked you about yet that's burning brightly on your radar that you feel you should be sharing with the audience here?
No, I mean, just maybe why we didn't get invites to the Jeff Bezos wedding. I don't know.
Yeah, I don't
I
know,
mean,
right?
some massive oversight on their part. No, I mean, seriously, I think we covered a lot of ground. But yeah, I think there's not much that we missed that I am focused on right now. I'm obviously, as your audience can tell, myopically focused on the 10-year bond yield,
Well, for very important reasons.
yeah, and the consumer credit. So we'll see.
All right. Well, okay, folks. Well, in 2 weeks, we'll be back to our normal live format. And if there are burning questions that I didn't think to ask Steph today, you can let us know in the live chat next time, and I'll toss them out to Steph there. Um, okay, Stephanie. So most important for folks that would like to follow you in your work between now and 2 weeks from now, where should they go?
They can just go to macromavens.com and you can read some sample reports and get information about how to subscribe right there, or you can follow me on Twitter at spomboy, or just here every other week with Adam, as
All
long as
right.
you'll have me.
We'll have you forever, Steph. Okay, folks. So first, please show Steph your appreciation for giving so much of her time with us again this week by hitting that like button and then clicking on the subscribe button below. And actually, folks, please take a moment to hit that subscribe button. I keep looking at the percentage of people who watch these videos who are subscribed and unsubscribed, and the unsubscribed percentage is far too high. The benefits of subscribing too is you get alerted every time we publish a new video, so you won't miss new videos going forward. And it also really does help this channel get further love from the YouTube, the higher percentage we have of folks who watch who are subscribed. So it only takes you a second, but it actually does make a big difference for us. Also, if you are thinking about either increasing your exposure to the precious metals or maybe getting into them for the first time, don't forget to read the free guide that Thoughtful Money has out there at thoughtfulmoney.com/gold. And it's really just a primer that walks you through all the different ways in which you can own gold to help you basically make the most informed decision of the right way to buy it for you. Lastly, if you want some help in positioning your portfolio in general, but maybe specifically for some of these risks that Stephanie has laid out for us, I highly recommend that most folks watching this video get that help from a good professional financial advisor, but very importantly, one that takes into account the issues that Stephanie has talked about with us here. And when you add that last requirement in, the universe actually shrinks pretty dramatically. But if you've got a good one who's doing that, who meets that criteria, great, stick with them. But if you don't, or you just like a second opinion from one who does meet that criteria, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. As a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free service that they offer to be as helpful as possible. All right, Steph, look, one thing that we can, I think everybody watching can celebrate, regardless of your political persuasion or just your views on life, are that I just heard right before we came on here that TSA has dropped the you have to take your shoes off requirement.
Yeah, I love that. Thank you.
So it's not all gloom and doom, folks, right? There are some bright rays of sunshine in our lives. And hopefully on my travel this week, your travel when you go home, Steph, you can just walk right through TSA and not have to worry about untying your
I
shoelaces.
love it. No, that's such, it only took 24 years to get that.
24 years. Yeah. And I haven't heard the stats on it. I remember the guy that they caught,
Oh yeah.
who tried to do it. And I want to say he was almost like the underwear bomber or whatever. Like he
Right.
had something in his underwear, but when they caught him, he was trying to set his shoes on fire as well. But
Exactly.
I've never heard since then that, oh, we caught this guy at the airport who had something in his shoe. Like I do wonder in those 20 some odd years, did we
Right.
see anybody with anything in their shoe?
No, and yet amazingly, they routinely find people who have like knives and guns and all this other stuff in their luggage, in their carry-ons. So they have to take that out. But shoes, yeah, I've never heard that anyone tried again to bring anything threatening in their shoes, but who knows?
Well, look, I'm a big supporter of law enforcement and the folks that are keeping us safe from everywhere, military, whatever. I know a lot of good folks, in the TSA trying to do the right thing for the country, but I have seen those reports over the years, Steph, where there's a bunch of people that go through, testing the system with knives and guns who make it through with them
Oh,
not getting
God.
caught, right? I mean, that's the thing that really scares you, right? And they're too
Yeah.
busy looking at people's shoes or their belts, and we're missing the actual weapons that we're going through.
I mean, at a minimum, if they're going to make you take your shoes off, they could do like a smell test and say, you can't get on this plane. And that would provide a real service to passengers on the plane. I would take that. Anyway.
All right. Well, look, Steph, thanks so much. We'll leave it at that. And look, I didn't see her in today's video. I might not have been paying good enough attention, but please give Wilhelmina a scratch for me and from all of us.
I'm confident you heard her because she's been snoring like a truck driver over here for. Oh, well, thank you so much, Adam, and best to Boston and Bodega, who are living out there.
Thank you. They say hi, and get in a good ruck for me, Steph.
I'm going to try.
All right.
Okay.
All right. Everybody else, thanks so much for watching.